Commissioners, Matt Freedman here with the Utility Reform Network. I'm happy to be able to talk about this issue today. Appreciate this opportunity. TURN supported the original legislation that allowed CCAs to form. We liked the idea of CCA because it was an alternative to direct access. Unlike direct access, which is dominated by cherry picking of profitable and lucrative customers, and with no obligation to serve, and in a market that ultimately became unstable during the energy crisis when direct access providers defaulted customers back to the utilities due to high prices. Community choice aggregation offers an interesting public-based alternative, obligations to serve all customers in the community, and particularly looking out for residential customers. And we understand that CCAs will be an important part of the state's procurement going forward. Why are CCAs taking off now? Well, they're taking off because there are very low market prices, both for conventional energy and renewable energy. Those are driven by significant surpluses in the market. Those surpluses have occurred primarily due to long-term contracts executed by the investor-owned utilities at the direction of this commission. And meanwhile, the legacy resources in the utility portfolios have higher prices than what they're seeing on the market today for new resources. Does this remind anybody of a historical period that many of us lived through? This is the mid-90s, where there was a desire to allow competition to take advantage of low marginal costs on the market. We have the added factor today of intense public dislike of the utilities and a desire for alternatives. This isn't to say that community choice is a mistake. It's simply to point out the historical parallels and to make sure that we don't make the same mistakes this time that we did last time. I've taken a look at the performance of CCAs in terms of their resource portfolios and done a bit of a deep dive into their plans. What I found kind of breaks into two categories, past and future. The past performance of CCAs, in my view, has been underwhelming. There's been a heavy reliance on out-of-state resources that are existing operating resources, lots of short-term contracts, lots of unbundled renewable energy credits. These are not impressive portfolios if they are the ones that represent an end state for CCAs. For example, Sonoma Clean Power bought a bunch of unbundled RECs from an Idaho wind farm that was built under a PURPA contract selling its power to the Idaho utility. There's not much incremental about that. And Marin bought a lot of unbundled renewable energy credits in their early years as well. But that's the past, and I'm interested in looking at the future. So when we look forward, based on the resource plans that have been released, the RPS compliance reports that have been submitted to this commission, what I've been trying to understand is how much additionality these resources and these plans are going to bring to the state. What new things are going to happen? And I'd say that the CCAs, in my view, I did not look at all of them, I did look at 4, fall into a couple of categories. I'd say the most disappointing would be Lancaster, despite the fact that they are located in the most abundant region for solar resources in the state. They are only projecting to get about 5% of their retail sales from new resources, a single contract. Most of their resources are generic contracts for renewable resources to be named later under short-term deals. And about 70% of their renewable energy is supposed to come from out of state. Now, I understand they're new, but I think it's important to understand what CCAs are actually doing. I'd say the most improved and really leading the pack today by a long shot is Marin Clean Energy. In the last year or two, they have engaged in substantial amounts of long-term contracting. And they have a goal, I understand, of 80% renewable energy by 2025. But more importantly, Marin is poised to obtain over 1/3 of their entire retail load from new local renewable energy projects by 2019 and over 50% by 2020. So it's a real impressive focus on local resources and new development. This is the benchmark for meaningful procurement, in my view. If I were to look at who's making progress but still needs improvement, I'd look at Sonoma. Although Sonoma did sell and liquidate all of their unbundled REC positions in 2016, so they're out of the unbundled REC market. It looks like that Sonoma is going to obtain about 14% of its retail sales from new renewable energy resources in the next few years, but there's a heavy reliance on large hydro from out of state, and I think this is an important issue for the Commission to understand. For example, Sonoma plans to get 41% of its entire retail sales from legacy hydro projects in the Northwest this coming year. And they plan to source about 50% of their total portfolio from out-of-state resources. To me, this is not a good weighting, and it represents a desire to pick up stuff that's already out there and that is inexpensive. In terms of the jury is still out, I'd give that to Clean Power SF. They just started, so we want to give them a bit of a break. But they did buy all in-state resources, RPS Bucket 1 for their renewables. But there's really nothing new that's been put on the table so far. By the way, this analysis was not easy to perform. There's not a centralized source of data. The CCAs were all cooperative in providing me with data privately, and some of them have good resource planning documents, particularly Marin. But an average consumer would never be able to perform this analysis. And why does it matter? Because consumers want more clean energy. That's what's driving this movement. But they don't understand what's meaningful. And what they're told is you should buy into a high percentage renewable energy product or a low carbon content renewable energy product. But the reality is complicated. And just giving these numbers doesn't tell consumers something that is actually indicative of what's happening in the universe. We need to understand the impact of CCAs on actually developing new resources. That's the goal of this exercise. The state has ambitious goals, and to get there, there has to be a lot of heavy lifting going on. And the emphasis on big percentage numbers and low GHG numbers has, in the early years, distorted the choices that have been made to look for quick, easy fixes to obtain these benchmarks. For example, big purchases of legacy out-of-state hydro projects that literally will operate regardless of who buys them. What drives hydro output in the Northwest is rain and environmental permitting conditions. It's not whether a CCA decides to sign a contract, and those publicly owned utilities in the Northwest are more than happy to sell those products at a premium to California and then turn around and buy power to meet their own needs on the spot market, which, by the way, most likely results in dispatch of fossil units. There's a whole secondary dispatch problem here that we need to look at. So I think it's important to take a deeper dive to understand what matters here. The CCAs have all offered voluntary products that are 100%. Marin's product started out really as a heavy unbundled REC offering, which in my view is not meaningful, but they've switched to a bundled product now from local resources, and I think that's an improvement. Sonoma is offering a product that's basically all geothermal from the geysers. And the utilities, of course, have their programs which are focused on new resource development. And when the new resources they're procuring come online, those customers will be served entirely with brand new resources that are within the service territory. So I think the most important thing I want to leave the commissioners with in my opening presentation here, the utilities have primarily procured new resources, particularly on the clean energy front, under long-term contracts. That's what got us to the state of success that we're in today. New CCAs, when they form, primarily sign short-term contracts for existing resources. And it takes many years for CCAs to be able to get new projects built. Marin started in 2010, and they look to have a pretty impressive portfolio coming online in the next couple of years, but that's actually quite a long number of years if we try to take that same increment of time and project out into the future. So the very immediate effect of migration to CCA is that we are trading long-term procurement of new resources by the utilities for short-term procurement of existing resources by CCAs. And if the utilities lose a significant chunk of their retail load, they will have no appetite for new resource procurement. You already hear it from them in pretty much every proceeding. They're not interested in signing up new contracts. And so we need the CCAs and the direct access providers to pick up the slack by developing new resources. Otherwise, we are facing literally a valley of death for new resource procurement. The pipeline is going to run dry. It already is running dry. And this raises critical questions for this commission and how it conducts its oversight of the CCAs and the DA. providers because they need to do heavy lifting to meet state goals. Everyone's going to need to sign long-term contracts, get new resources built. No one's going to be able to get a free pass on this because if they rely too heavily on existing resources, then we end up back where we started from, which is a supply crunch down the line with higher prices. So I'll stop there, and I know that's way over my 5 minutes.